This is a Podfast summary of the interview between Peter McCormack, Danny Knowles, and Luke Gromen. In this conversation, Luke and Peter discuss and dive deep into some thought-provoking and interesting topics about how governments can navigate the first busting global debt bubble in 100 years. Here are 8 key Podfast takeaways from Peter McCormack's interview with Luke Gromen. Key takeaway number 1. Bitcoin as a neutral reserve asset. Bitcoin could be considered a neutral reserve asset, as it is a decentralized digital currency that is not controlled by any government or financial institution, which makes it free from political influence or manipulation. It also has a finite supply of 21 million coins, which gives it a fixed scarcity similar to gold, and this scarcity helps to maintain its purchasing power over time. Luke and Peter go on to discuss the importance of owning a neutral reserve asset with an energy tie, which is crucial in maintaining purchasing power in energy terms. Luke believes that owning an asset without counterparty risk, which hedges inflation, is critical in the current scenario of a bursting global sovereign debt bubble. He suggests that Bitcoin can be seen as an energy-tied reserve asset, as it uses a proof-of-work dynamic. They also compare the current situation to the UK after the Napoleonic Wars, where a productivity boom helped the country earn its way out of the sovereign debt bubble. Key takeaway number 2. Inflation in the U.S. Luke Gromen discusses the potential risks of extreme policies required to fix the economic situation in the U.S. The United States is currently experiencing an inflation crisis, which means that the general level of prices for goods and services is rising rapidly. The main drivers of inflation include supply chain disruptions caused by the pandemic, labor shortages, and an increased demand for goods and services as the economy recovers. The U.S. government has also implemented significant monetary and fiscal policies to stimulate the economy, which can contribute to inflation. Luke suggests that a short-term reset may be inevitable, allowing inflation to increase for a few years. Luke cites Israel's successful implementation of high inflation in the past and suggests that the U.S. could follow a similar path. However, he also warns that delaying the inflation only increases the likelihood of a compressed period of high inflation. Key takeaway number 3. Strategies for protecting against inflation. Inflation means that the prices of goods and services increase, and if the value of your money doesn't keep up with those price increases, you can end up with less buying power than before. This can make it difficult to save for the future, and it can also have a negative impact on fixed income investments like bonds. Luke and Peter suggest various strategies for protecting against inflation, including investing in real estate, gold, and Bitcoin, as well as being diverse and underleveraged. They also go on to warn of the face-peeling volatility that could come with the path to high inflation. Key takeaway number 4. Diversification in uncertain times. Having a diversified investment portfolio is beneficial, as it helps to spread out the risk across various asset classes and reduces the impact of any one asset's performance on the overall portfolio. By investing in a variety of assets, such as stocks, bonds, real estate, and commodities, investors can potentially achieve higher returns while mitigating risk. Peter and Luke go on to emphasize the importance of having a diversified portfolio in order to help navigate through these uncertain times. Some of the strategies discussed include investing in conservative leverage, diversified cash, Bitcoin and gold, neutral reserve assets, energy products, industrial equities, and good balance sheets over bad balance sheets. Key takeaway number 5. Moving away from the dollar as the global reserve currency. Luke and Peter talk about moving away from the dollar as the global reserve currency, and how this could benefit the world as a whole, including reducing the debt burden and giving the world a debt break. Peter also highlights the importance of gold as a reserve asset, and how it could potentially become a neutral reserve asset in the future if the dollar loses its status as the primary reserve asset. Additionally, it could reduce the risk of inflation and currency depreciation caused by excessive printing of dollars. Finally, it could promote a more multipolar world by allowing other countries to play a larger role in global finance and governance. Key takeaway number 6. The falling dollar's effect on the U.S. economy. A falling dollar can have a significant impact on the U.S. economy for several reasons. First and foremost, it affects the cost of imported goods, which becomes more expensive for American consumers and businesses. This leads to inflation, which erodes purchasing power and reduces overall economic growth. Luke Gromen suggests that a weaker dollar can increase production and move the U.S. economy away from Washington and Wall Street towards more productive enterprises. He also mentions that the falling dollar can reduce the debt burden globally, which can lead to more global demand. Gromen proposes moving from treasuries as the primary reserve to gold at a floating rate in all currencies as a way to strengthen the U.S. economy. Key takeaway number 7. Potential consequences of high inflation. High inflation can have significant consequences on individuals, businesses, and the economy as a whole. For individuals, high inflation leads to a decrease in purchasing power, meaning their money is worth less, and they can buy fewer goods and services with the same amount of money. This can lead to decreased standards of living, decreased savings, and increased debt. Luke and Peter highlight the potential consequences of delaying the inevitable inflationary period, including capital controls and the government's attempt to maintain credibility as inflation fighters while also needing to finance the government. They also contemplate and chat over the impact of high inflation on the economy, and suggest that as long as consumer prices and wages are able to keep up with inflation, it may not be catastrophic for the country as a whole, but bondholders will likely be negatively impacted. Key takeaway number 8. The benefits and risks of a weaker dollar. A weaker dollar can benefit a country's economy by making its exports more attractive to foreign buyers, which can boost demand and create jobs. Luke Gromen believes that a weaker dollar is beneficial for the USA, but not for certain Washington, Wall Street, or Chinese interests. He warns that the outcome may have fat tails based on geopolitical issues, like leading to higher interest rates as foreign investors demand higher returns to compensate for the weakened currency. Thank you for listening to this Podfast between Peter McCormack and Luke Gromen. If you enjoyed this content, please like and subscribe. See you next time.